Hello, and welcome to another episode of SoCal Multifamily Insights, where we help you decode market trends, uncover hidden opportunities, and help you stay ahead of the curve when it comes to multifamily investing. I'm your host, Jack Patel, veteran multifamily advisor and entrepreneur here in Long Beach. And today we're going to be tackling one of the questions that I get a lot from that a lot of investors don't understand, the 1031 exchange. Today, I'm joined by Jordan Phillips from IPX 1031, and we're going to break down how a 1031 exchange and the timelines you need to go by. So, Jordan, thanks for coming to the show.
Thanks, Jack. Appreciate
it coming out here. So, before we get into the questions and how the 1031s work, tell us a little bit about yourself.
Sure, yeah. So I've been with IPX 1031 for the last about 7 years, since 2018. So we are what's called a qualified intermediary. So our role is pretty straightforward. Our role is 24/7 to facilitate 1031 exchanges. So we'll go in that in a little bit more detail, I'm sure a little bit later on. But as far as my background, so actually prior to me joining IPX, I worked as a commercial real estate agent, mostly doing tenant representation. And I was simultaneously going to law school at the same time. So while I was working at the company I was at, which was Lee and Associates down in Carlsbad, my current business partner, his name is Stephen Decker. He came in, did a 1031 exchange presentation, and I thought, wow, I'm taking a lot of tax law classes. I'm in real estate. A 1031 exchange is kind of a great combination of both, real estate and also taxes. So once I graduated law school, I thought, yeah, can I be an attorney? Yeah, I'm not sure if I'm really cut out for that specific lifestyle. I'm more of, sales guy, getting out in the field, meeting with customers, trying to generate business. So I put a call into IPX and I said, here's my resume. Here's what I can provide to you. And, before you know it, graduated law school, started with IPX and, been there ever since.
Oh, nice. Which one do you prefer? Tenant representation or being an IPX 1031?
Not even close. IPX, doing the 1031 exchanges. Tenant representation is great. Someone's got to do it, but that's a very challenging job, to work with, tenants on all the process, the tenant improvements and all that good stuff. My job is a lot more straightforward, which is probably better suited for me.
So let's talk about that straightforward process. What is a 1031 exchange?
Sure. Yeah, man. 1031 exchange is actually, for real estate, the greatest wealth preservation tool in the entire tax code. So what it allows you to do is anytime you're selling investment or business real estate, the IRS allows you to defer paying your capital gains taxes by going out and buying other investment or business real estate, which for people like us in California is a massive benefit, right? Because if you own investment property, you're selling it and you're going to be paying your taxes. When you blend together the federal and state taxes of California, you're looking at close to almost 40% tax rate. So that's usually where I get the call from clients a lot of times. Oh crap, I just spoke to my CPA. I found out I have this massive tax burden that I'll have if I cash out. Tell me a little bit more about the exchange.
So what's the process of the exchange? So I'm a seller. I get this call from my CPA as well. Hey, you're gonna sell your 5-plex or 4-plex, whatever it may be. You held it for 10 years. You had all this depreciation. Now it's time to. What are you gonna do? You're gonna pay the tax and cash out, and I don't want to pay it. So we're in escrow. Where we go from there?
Well, the good news is that mechanically speaking, a 1031 exchange is extremely simple to set up. So like I said, I'm with what's called a qualified intermediary. So our role is essentially anytime you do a 1031 exchange, the IRS actually requires that a neutral third party like us facilitates the exchange. So what that entails is, during the escrow process, we would have to draft a set of 1031 documents that you have to sign before the property closes. I'm going to emphasize before the property closes. So you cannot set up a 1031 exchange after the closing. And that's like the worst phone call I get from clients. Oh, I just closed yesterday. The money's still sitting in escrow. Can I do a 1031 exchange? Unfortunately, the answer to that is no. So the IRS says that if the exchange is not set up before the closing, it's a taxable event or a taxable sale. So we just have to prepare a set of documents, and I'll get calls from clients the day of closing. not the best situation, but we can make it happen. Draft the documents, they sign them, and then our other role is that the IRS says that you cannot hold your funds in between your sale and your subsequent purchase. So we set up a bank account to hold those funds. Money goes into that account at the closing and sits there until the replacement property is purchased.
That is the exact call I get. Hey, Jack, I just sold my property. Now I'm thinking of doing a 1031 exchange. So where's the money? Oh, it's getting wired over. Sorry.
Yeah.
Yeah.
You're done.
Yeah.
Yeah. So we set up a completely segregated bank account for each of our customers, opened up using their taxpayer ID number. So the money is physically sitting at a bank, but it's not their bank, right? It's a bank that we set up for their exchange.
So yeah, if you guys are listening and you're thinking about selling your property and doing a 1031 exchange, reach out first to qualified broker and intermediary, because you'd be surprised, how many investors have owned multiple properties that a lot of people don't know about the process of the 1031 exchange, especially when it comes to a qualified intermediary and the funds. Like once they touch, we close. So, a lot of education out there. So make sure you research on that and go from there. Once the property is closed and you do it correctly, you guys, obviously, the escrow wires, the qualified intermediary, right now in this example, yourself and your company, then what's the process? You have to identify your uplink, correct?
Yeah. So the good news about the exchange is that you can do it, right? The IRS allows you to defer your capital gains taxes, but we are still dealing with the IRS. So they're not going to make it super easy to complete, right? So they're going to impose these timeframes that you need to abide by. So the clock for the actual exchange will start upon the closing of the property that is being sold. So from the closing of the sale, you have 45 calendar days to identify the property or properties that you want to purchase, and a total of 180 days to close on your purchase or purchases. So 45 days to identify, 180 days to close, and both of those time frames start upon the closing of the property you're selling.
Okay. So 45 days to identify how many properties?
So the IRS does limit how many properties you can identify. So you can't just go out and identify all of Long Beach, right? That'd be nice, right? Multiply will buy one of those properties, right?
Correct.
That's not going to work. So the IRS says that there's basically two identification rules, and you could pick one or the other. So the most common is what's called the 3 property rule. So what that says is if you identify 3 or less properties, the total value of those properties does not matter. So the 3 property rule is 3 or less. Properties could be any value. Now, when it comes to an exchange, a lot of our clients are selling in California and buying in other states, maybe Nevada, Arizona, Florida, Texas, where properties are a lot cheaper, right? So they might want to identify more than 3 and diversify. So if you identify 4 or more properties, you can, but if you go 4 or more, the total value cannot exceed 2 times your sales price. So let's say you sell for $1 million and you want to identify 4 or more properties. The total value of those properties could not exceed $2 million.
Okay.
So you're either limited on the total number of properties, 3 or less, or the total value of the properties.
And if it's 3 or less, there's no limit to the amount.
There's no cap. So usually people, a lot of times in the exchange, will sell one, buy one, and they'll identify 3 different options. They'll use the 3 property rule. But for people who want to diversify, like I said, going out of state is oftentimes when people diversify, they'll use that 200% rule.
And what kind of properties can I choose, or can an investor or someone choose from in an exchange?
So there's basically 3 requirements. 1, it has to be real estate. So you have to sell and buy real estate. 2, the property has to be used as either an investment or in the use of a business.
Okay.
And 3, the property has to be within the United States. So you can sell and buy in any of the 50 United States, the U.S. Virgin Islands, Guam. You can't sell in U.S. and go out and buy a property in Italy or Japan or Australia. It does have to be U.S. for U.S. So the 3 requirements are, like I said, real estate used as either an investment or in the use of a business within the United States. So property type does not matter.
Okay.
So if you wanted to sell your single family rental, go out and buy a duplex, a fourplex, eightplex, commercial real estate, office, industrial, retail, vacant land, oil, gas, mineral rights, billboards, windmills, as long as it's real estate, it will actually qualify.
Or so long as it has a APN,
Yeah. So it has to be real property.
real property.
So personal property exchanges, like you used to be able to exchange things like airplanes for airplanes or
Oh, wow.
cars for cars or collectibles, artwork. You could do all that prior to 2018. So as of 2018, the IRS basically got rid of personal property exchanges, and now they're strictly for real estate.
Oh, okay. Financing
Mhm.
when it comes to a 1031 exchange, debt. Can you explain on, let's say an example, I sold a $1.5 million property. I had $800,000 in debt. When I do an exchange, do I have to take on the same amount of debt, or can I go buy something, for 700,000 that's left over free and clear? How does that work?
Well, so in order to defer all of your capital gains taxes in a 1031 exchange, essentially the number the IRS looks at is your sales price minus any closing costs,
Mhm.
right? So like commissions, title fees, escrow fees, you can deduct all of that off the sales price.
Okay.
So let's say, for example, going back to your numbers, after closing cost, you sell for 1.5. So the first requirement is that you buy for 1.5 or higher. So you do have to buy for that full 1.5 or higher. When it comes to the debt and equity, right? So you have 700,000 of equity and an $800,000 loan. You do have to roll the full 700,000 into the purchase.
Okay.
So any money that you do not reinvest and you touch, doesn't matter what you buy for, that will be subject to taxes. So any money that does not get reinvested from the sale to the purchase is taxable, what's called taxable boot.
Okay.
As far as the 800,000 is concerned, the IRS just requires that you replace the value of that debt. So like if you said, hey, I'm going to buy for 1.5, I've got the 700,000 of equity. If you wanted to get a loan for 800,000 to buy that property, totally fine. Or if you say, hey, look, rates are a little bit too high, I have 800,000 of cash that I can use. You could use 800,000 of your own cash to replace that debt.
Okay.
So that how you replace the debt value is up to you. It could be a loan or more cash, but there's no options as far as the equity is concerned. That all has to go into the purchase.
Right. And if not, you get taxed,
You
which
get
is
taxed.
called a boot.
But yeah.
Right.
Or if you, let's say, for example, sell for 1.5 and buy for 1.3, that's still a valid exchange. That's what's called a partial 1031 exchange, and you would pay taxes on that $200,000 difference.
So if someone wants to, want some cash after their sale, they'll pay them. And that goes, how does the percentage of that tax rate go on that 200,000? Is it specific, or it goes specific to the individual and their tax bracket?
It goes to their tax bracket. So, and that happens a lot, right? In Southern California, we have clients who own properties for 20, 30 years. They have tons of liquidity, tons of gain. They can still keep some, free up some cash, pay some taxes, and exchange the rest and still get massive benefit from the exchange. But as far as the actual rates are concerned, they're going to be subject to federal, capital gains rates, which at the long-term capital gains rates is either 15 or 20%. They might be subject to what's called the net investment income tax, which is 3.8% to the federal government. And then the state of California, tax rate wise, treats capital gains the same as ordinary income. So that's usually another 9 to 13.3%. So when you blend all of that together, you might be looking at a tax rate somewhere in the mid 30s ish.
Okay.
And most of our clients are in the higher tax bracket, because the actual gain from the sale will probably push them in to a higher rate. So like on 200,000, maybe they're going to be paying 70 grand of taxes roughly. And that's a number we always say, hey, look, check with your CPA, because you don't want to get that April surprise. Oh crap, I thought my taxes were going to be way lower than they're going to be. I wouldn't have done this if I known my taxes were going to be this high. But at the end of the day, a lot of our clients do, keep some cash.
Okay. So in those scenarios, if someone wants to sell and cash out, that would be the option right there. This is what they would go through. When it comes to someone that or an investor says, hey, you know what? I've owned this for 30, 40 years. I don't want to even handle it. I just want to cash out. What if they don't do an exchange? So basically, I know that's more of this is more of a CPA question, but typically they go through what's the process. They'll sell it, then they pay all the taxes, and the depreciation gets recaptured. Correct?
Yeah. So let's say, for example, you sold a property today. I'm not doing an exchange. I'm going to cash out. Typically speaking, the state of California has a withholding, which is 3.3% of the sales price. So that's essentially withheld at the closing. It's sent to the Franchise Tax Board of California, and that's going to be applied to your 2025 taxes. And then the rest of the money is sent, directly to you. And then when you file your 2025 tax return next year in 2026, all of that gain that you have to report it and subsequently also pay your taxes on it. So, I mean, you don't have to pay your taxes right away. You would pay it when you file your tax return next year.
Okay. I always had this question too. There's one is same example. We sold it for 1.5, right? Pay the debt off. But now I want to buy a property, or an investor wants to buy a property at $3 million. But this time we're going to bring in an investor. When you and the property that's being relinquished, the down leg, it's held under an LLC, correct? So how do you bring in the investor or another partner to the up leg if you're still, because when you sell a property, when you do a 1031, and if it's an LLC or an entity, that same entity has to buy that up leg for the 1031 to qualify, correct?
Yeah, I'm glad you mentioned that, Jack, because that is not a very sexy requirement of the exchange, but it is a paramount exchange requirement that you sell and buy as the same taxpayer.
Yeah.
Right. So when you file your exchange, you have to be able to file it, the sale and purchase on the same tax return. Right. So if you sell in, one entity and buy in a different one that are different taxpayers, it's going to blow the entire exchange.
Correct.
So structurally speaking, let's say, for example, you sold your down leg for 1.5 and you said, hey, look, I want to go out and buy a $3 million property. I might not have enough, equity to buy the property, or I might not be able to qualify for financing by myself. I want to bring in another investor. You could, but how you take title is critical. So you'd essentially have to take title to the property as what's called tenants in common.
Okay.
So you buy a fractional interest. So let's say you sell for 1.5, you do the exchange, and I'm going to come in and buy the property with you. So you would buy a portion of the property. I would buy a portion of the property. So let's say the property it's worth $3 million and you sold for 1.5. For you to completely defer all of your taxes, you would want to make sure you acquire at least 50% of that property, right? Because 50% of 3 million is 1.5 million. So that's a big thing to keep in mind, is that whatever your fractional interest, percentages, you want to make sure that that portion is equal to or greater than in value to what you're selling.
Okay.
But the tenancy in common structure is very common. But what we could not do is say, hey, let's go out and form a new partnership and buy the property together under this new partnership 100%, right? Because you're selling as, you're separate individual or trust or LLC or whatever, and now you're buying under this new partnership. That would blow the exchange.
Common mistake that I always see happen a lot. The other one is the inverse of that, or the reverse of that. Hey, 3 partners, we made this equity, we sold this property, 2 want to get out, 1 wants to do the exchange. How does that work?
So that is very, very common, especially here in California, because the Franchise Tax Board, when it comes to these partnership issues and you're trying to get out of a partnership before the exchange, the Franchise Tax Board likes to keep a close eye on those types of transactions. So the problem is we'll go through different options, if that's okay. So
go for it.
So let's say it's you, me, and another investor, John.
Okay.
Right? So Jack, Jordan, John. I know we probably shouldn't be using all J's, but we are. Let's say, for example, Jack wants to do an exchange and John and Jordan want to cash out. So the simplest way, which is also the most risky, is what's called a drop and swap. So essentially what would happen is that if we were just to sell the property as the LLC, which is a partnership, we would have to buy as that partnership.
Correct.
So if I took my 1/3 of the funds, John took his 1/3 of the funds, that would pretty much create boot for the entire LLC and would negate any sort of tax benefits for the LLC doing the exchange.
Right.
So we really need to separate ourselves in order for you to be able to do an exchange with your portion and for me and John to cash out and not cause any tax liability to yourself, because that's what you're trying to avoid is tax liability for you.
Correct.
So the drop and swap would be where we drop out of the LLC as what is tenants in common. So you own your 1/3, I own my 1/3, John owns his 1/3. And then when we sell, you could take your 1/3, do an exchange. I could take my 1/3, John could take his 1/3, and we can cash out. The problem with that is the franchise tax board has been pretty notoriously aggressive on those transactions. And their reasoning is let's say we drop out of the LLC and immediately sell, and you do an exchange. Well, one of the requirements of the exchange is that you sell and buy real estate that you held as a long-term investment, right? So while the LLC has owned the property for presumably years and could have done an exchange, you individually maybe have only owned the property for a month or a couple weeks. Therefore, you did not hold the property as a long-term investment. You held it for a very short period and tried to do an exchange. So the IRS typically doesn't go after those transactions in the Ninth Circuit, which oversees California, but the Franchise Tax Board certainly does. So if you were to do the drop and swap, do the exchange, there's certainly a risk that you might get a knock on your door from the Franchise Tax Board saying, "Hey, Jack, what the hell is this? We're going to overturn your exchange."
Oh, okay.
Alternatively, the most probably or less risk averse option would be to essentially carve John and I out of the LLC before the exchange. And that's through what's called a redemption agreement. So maybe before escrow, during escrow, whenever, John and I would go and say, "Hey, look, we want to redeem our 1/3 interest in exchange for a 1/3 interest in the real estate. So instead of being a 1/3 owner in the LLC, we'll be a 1/3 owner in the real estate." So what happens is we redeem our interest. There's a new deed recorded, right? So the LLC, which you're the member of,
right,
owns 1/3 of the property. John and I each own 1/3 of the property. Then when we sell, the LLC, who's owned the property for years, now owns 1/3 of the property and can do an exchange.
Okay.
One caveat on that is, I know we're probably getting a little bit technical, but you asked the question.
Right.
If you did that strategy, you would want to make sure that you added someone else to the LLC. It could be John or I staying for 1%, you add your wife, whoever. Because in order for the LLC to maintain its status as a partnership, there has to be 2 members.
Oh, yeah, that's correct.
So someone else stays in there. You keep the LLC together as the partnership. You do the exchange. You defer your portion of the gain. John and I pay our taxes. So in California specifically, because of the Franchise Tax Board, that option's a lot more common than the actual drop and swap. There's other options, but I mean those are pretty much the primary ones.
That is, yeah.
So yeah, when it comes to partnership issues are something that, look, there's issues in 1031 exchanges.
Right.
They can always be corrected. A lot of times they might need more advanced planning, tax planning, like things that probably can't be corrected, like the day before the closing. So the earlier you can get myself, your CPA, your tax advisor involved, the better. Because no matter what you're doing, most of the time with advanced planning, it can be, rectified.
Yeah, that's like kind of the message I give, to my viewers and clients. If you guys are, especially if you're in a partnership, if you're planning on selling or planning on exchanging, it's not something that you just, most of the time it's not something that you just do in a month, like we have to kind of plan it out, see, what's going on, especially on the down legs structure as you move forward. One thing I always come up with also is when some clients do call me and they're planning to do a sale or going to do a 1031, they go and, hey, we're going to go refi this property and then we're going to sell it in about 6 months. And I'm like, you know what, that might be considered a red flag. Or another thing I heard is, hey, I'm going I'm going to sell this property. I'm going to go buy something for this amount that I'm going to have in the 1031 exchange and then refi after I close my uplay. Now, I've heard two different scenarios on, or actually I heard a lot of stuff on either or. Like, some can get disqualified or you should do it this time or this and that. Can you go a little bit more further in detail of which one is correct and which one is not?
Yeah. So as far as refi before or after, most CPAs will say after, a lot more or less risky than before.
Okay.
The problem is so the IRS's rationale for before the exchange, let's say, for example, you refi and 2 months later you sell the property. They use what's called the step transaction doctrine, which basically is, let's say you refi and you put 500,000 into your pocket from a cash out refi. If you do it too close to the closing, what they do is they basically lump those two transactions together, the refi and the sale, and they basically say, hey, look, you're putting 500,000 of sale proceeds into your pocket, right? So we're going to consider that boot by doing the refinance right before the close. So as far as how long you should wait, I've heard 6 months, before the closing. What you really want is, if you're going to be doing the refi, to have like an independent business purpose for doing the refi and not just saying, hey, look, I want to put cash in my pocket. Whereas if you do the refi on the purchase, as long as the refi is started after the closing of the purchase, most CPAs are fine if you do it immediately. So if you're looking to, and this came up a lot, when rates were really low, right? Hey, look, I want to put some debt on this property because you can get a 3% interest rate or whatever. So it's a little bit different now when rates are higher. We don't see it as much. But certainly refinancing after the exchange is complete is, in the eyes of most CPAs, a lot less risky than refinancing right before you close on your sale. In either event, that's, as the qualified intermediary, we're not your tax advisor, we're not the IRS, we're not the IRS's police, most importantly. So if you are going down that route, we're not going to stop you, but you should, just check with your own CPA.
Okay, good to know. I kind of get that a lot with the CPAs as well, and kind of guide clients to that direction. You dropped a lot of knowledge on us and the viewers too, and I really appreciate that. Going to a qualified intermediary like yourself, I know you probably you don't want to bash on anyone or something, but if I was a client and someone comes to me and says, Jack, hey, who do you recommend or what do you look for in a qualified intermediary? Are they all the same? They don't pretty much do anything? Or so how, if I was coming to you and say, or someone came to you and said, Jordan, why would we choose your company over others? What is something we clients should look for, or investors that are watching this, like, to pick the right one and not fumble their 1031?
Yeah, well, I'll try to be as objective as possible, right? So as far as our kind of selling point is essentially the financial security of our company. So believe it or not, our industry as qualified intermediaries are federally unregulated. So there's no IRS or any sort of federal agencies that are overseeing our industry, which is
interesting,
kind of crazy considering we currently are holding about $4 billion of active exchange funds. So as far as what I would say to look for is, how are they protecting your money? Who are they owned by? How are they holding your funds? So my company IPX, we are wholly owned by Fidelity National Financial, which is a Fortune 500 company. So the same parent company that owns Fidelity Title, Lawyers Title, Chicago Title, Ticor Title, Commonwealth, they also own us as well. So we are owned by a massive Fortune 500 company. We carry the highest level of protection on our exchange funds. So we carry a $100 million Fidelity bond, a $30 million E&O policy, and most importantly, our parent company personally guarantees each of our exchange accounts up to $50 million bucks.
Okay.
And then as far as the banks we work with, we have our parent company has an entire treasury department that oversees our banking relationships. And we work with 3 primary banks, which are Citibank, City National, and US Bank, which are all, massive banking institutions. So we take every precaution that we possibly can to make sure that our clients' funds are as safe as possible during the exchange. So you asked me, why would you work with IPX? Objectively speaking, it's because we are the most financially secure qualified intermediary by far.
Well, yeah. I'm in exchange with you guys right now. So
We appreciate that.
yeah. So I did my research as well. So wanted to throw that out there. Jordan, a lot of knowledge again that you dropped on us, and I, appreciate that. Hopefully the viewers, learn something from that. If someone wanted to get in contact with you or follow you, where would be the best places to get a hold of you?
Well, so I'm not really on the socials.
Okay.
But I always have my phone on me, 24/7. So should I give my contact information out?
Sure.
Well, so my direct line is 442-287-7239. That's my cell, so you can call it, text it, whatever you need. So that's really, if I'm not out, meeting with clients or doing, speaking engagements, I'm really just behind my desk all day answering 1031 questions. So feel free, use me as much or as little as you would need, and that's what I'm here for.
Jordan, I appreciate it. Thank you for coming on and giving us a great education about the 1031 process.
You got it.
If you guys enjoyed this episode and would like more of these, please subscribe. Do me a favor, please subscribe. Drop me a comment and let me know if you would like something else or want me to cover another topic in multifamily investing. Until then, Jack Patel with SoCal Multifamily Insights. We'll see you on the next episode.